Have you ever received a paycheck of dividend from the bank for all the payments that you've sent the bank, saying, hey, thank you so much. Here's an exchange. Thank you for giving us all the payments, the interest. Here's the dividend on all your payments. Well, you're going to start seeing that once you control the function using a participating dividend paying whole life policy, because once you have a policy, once you become a policy owner, you become a co-owner of the insurance company. And when insurance companies become profitable, you get dividends. The tool that we use to implement the process of becoming a banker, and the tool is called participating dividend paying whole life policy. The short version of the name is PAR whole life policy. And the reason why we use this tool to implement the process of controlling the banking function, because this tool has all the attributes that are required for the purpose of financing and controlling financing. This tool allows you to become all the four characters in the financial play. The number one character is the depositor. You deposit money. You are a depositor. You've been depositing money in someone else's bank. We're going to change the address of that money. We're not going to change your cash flow. You're not going to work any harder. You're not going to take any risk, and you're certainly not going to change any of your financial goals. We're going to start by changing the address of where the money's sitting. It's sitting in someone else's bank. We're going to take that money and start depositing into policy as premium. That's how the money goes into policy, as premium. And then you're going to be the borrower, which is the second character in the financial play, because you're always dealing with borrowed money. You're either borrowing money from someone else, aka financial institution, and you're paying back principal and interest, or you're borrowing money from a future net worth, and you're reducing your net worth because you're spending cash. When you spend cash, you're also making a financing decision. So depositor, borrower, and then you're going to become the most important character, the bank owner, because you're going to make profit by financing things from your own banking system. Have you ever received a paycheck of dividend from the bank for all the payments that you've sent the bank, saying, hey, thank you so much. Here's an exchange. Thank you for giving us all the payments, the interest. Here's the dividend on all your payments. Well, you're going to start seeing that once you control the function using a participating dividend paying whole life policy, because once you have a policy, once you become a policy owner, you become a co-owner of the insurance company. And when insurance companies become profitable, you get dividends. And the companies that we use to implement the process of becoming a banker, they've been paying dividends to Canadians since 1848 without a miss. So think about the track record of insurance companies being profitable over the last over 170 years. A lot of things have happened when it comes to interest rates, economy, recessions, depressions, pandemics, but insurance companies haven't failed to produce profit because they do something different than everybody else. So you become the depositor, the borrower, the bank owner, and then you're also going to become the banker. The banker controls the transaction. The banker decides if the borrower should receive the loan or not. When you become the banker, then you self-qualify yourself for the loan. There's no qualification for the loan from the insurance company. You just have to fill out one single document page and you send it to the insurance company, and the loans come to you in your bank account in 5 to 7 business days. No questions asked, no income verification, no credit check. And then you also decide how to pay the insurance company back. So we're going to dive into the solution mode, and all these things will be covered. So your money must reside somewhere. So you have money is residing in someone else's bank. Let's just agree that money needs a warehouse. Money needs to be sitting in checking account, savings account, investments account. You may have money in your wallet. You may have money in your pocket. You have money underneath a mattress. You may have money tucked behind your toilet tank. Money needs a warehouse. So again, like I mentioned, we're not going to change your cash flow. We're going to change the address of where the money is sitting so that we can flow the money differently and radically improve the transaction that you have the need for use of money over that transaction. What I'm going to do is I'm going to do a thought exercise, a thought experiment. So let's assume that you today are devising your own perfect investment from scratch. You have a blank slate. You get to decide all the attributes of the investment that you're going to build. So think about what attributes would you assign to that particular investment, and I'm going to give you some hints. So I'm going to give you 2 hints. So how about if I was the one designing a investment from scratch, I would assign high rate of return, and then I may also assign consistent rate of return. What about safe, liquid, Compound, yes. Tax benefit, tax-free is no market reaction, yields income besides capital gain, creditor protection, inflation protection. You know, we are in an inflationary environment right now, so getting some protection against inflation will be important. Control. What about transferable to next generation, to someone else in the family that they can benefit from? Easy to manage. No hidden fees, penalties, or management expense ratios. What about reputable? Private. Keeping things private today, I think it's becoming more and more important. So think about where you are putting your money today, and then think about for your own various assets, simply identify which of the features from the list that I described above that your investments, your assets do well on, and which of the features they fail to satisfy. So you know your finances better than anybody else. So think about where your money is sitting now and how, based on some of the attributes that I've shared on this slide, think about where your assets do well and where your assets lack. So lacking is not a bad thing. It's just an opportunity, right? So what I've described to you, and this may be a surprise for some folks, those above attributes actually most accurately describes the attributes of a participating dividend-paying whole life policy. And some folks may not be aware of this, because every person in the marketplace, when it comes to life insurance, they only focus on one thing and one thing alone, which is, let's talk about what happens when you graduate, or let's talk about when what happens when you become an angel. The process of becoming a banker has nothing to do with life insurance. Life insurance is a benefit, exactly how the policy describes. It's a death benefit, it's a benefit. We're going to talk about all the living attributes of the policy today that you can use to control the banking function in life, the financing function. A participating dividend-paying whole life policy, short form for that is PAR whole life policy. So you may hear us saying PAR whole life. It refers to participating dividend-paying whole life policy. Now, there are many, many kinds of whole life policies, guys. We're not talking about just a whole life policy. We're talking about a unique participating dividend-paying whole life policy with very specific companies with very specific designs. Now, the word participating means that anyone who owns a policy or a system of policies, by virtue of you owning this policy, you become a co-owner of the life insurance company that holds the policy, and then you participate in the profits generated from every line of business that particular life insurance company produces, especially if your policy is with a mutual life insurance company. A mutual life insurance company meaning a company which is only owned by participating dividend-paying whole life policy owners. There are companies out there which are not mutual. They're tagged as demutual. In addition to participating dividend-paying whole life policy owners, they also have stock ownership in those businesses. So when you have a policy like this, you get profits. And profits have been paid in Canada with most companies since 1848 without a miss. Now, dividend paying. So each year, the life insurance company declares a dividend. It is contractually guaranteed to be paid to a participating policy. And the dividend can never lose value. It can never be repossessed. Whole life. The word whole life means is good for your entire life. It's there to help and serve a purpose till the end of time. Your life insured for whole life all the way till age 100. And then there's certain contractual guarantees which kick in once you have a participating dividend-paying whole life policy. And one of the contractual guarantee is that total cash value of the policy must equal total death benefit by age 100. So if you're just starting a policy today, for example, and I'm going to use me as example, I'm 39 years young today. So if I just start a policy today, I'm 39, and I'm going to be age 100 in about 61 years. So every day I wake up, I'm one day closer to age 100. And because of this contractual guarantee, my cash value increases because cash value must match my death benefit by age 100. So every day I wake up, my cash value goes up. Every day I wake up, if the stock market goes the other way, my cash values will still increase. Every day I wake up, if the stock market increases, my cash value will still increase. I wake up, the crypto market goes down, my cash values will still increase. I wake up, the crypto value goes up, my cash values will increase. I think you get the point. What happens in the policy is a contractual guarantee, and the growth of the policy has nothing to do with what happens outside of the policy. Contractual guarantee is by age 100, cash values and death benefit must match. Cash values can never be less than what it is today. It can only go up. We don't have many financial guarantees in life anymore. Pensions are going by the wayside. There's doubt about the future. There's a lot of uncertainty. However, dividend-paying life insurance can create a peace of mind and unmatched financial security. And here's how: because cash values begin to accumulate immediately. So the moment you start flowing money into the policy as premium, because money's got to flow, you're already flowing money to the books of someone else's bank, you just redirect the flow through the policy as premium. The moment money goes into premium, you will have cash accumulation. And because of contractual guarantee set by the insurance company, that cash value will start to grow immediately to match your death benefit by age 100. You have easy access to and control over a growing pool of financial value in the policy. And then if you have opportunities that come up, you can capitalize on those opportunities by borrowing against your ever-growing pool of capital. And the reason why we're emphasizing on borrowing, because we don't want you to interrupt the growth of your money. We want you to consistently keep growing money in the policy as you get to borrow against your own growing pool of capital. And when you borrow against it, you're able to borrow money directly from the insurance company without any qualification. You have on-demand access to capital to capitalize on high caliber opportunities, which are certainly going to come find you when you got access to capital. You're not penalized for accessing it early as you are in RSP or other financial products, because those attributes do not apply to a participating dividend-paying whole life policy. There are several tax advantages, both personally and corporately. The daily cash value growth in the policy, the zip tax on it, and the way we structure the dividend in the policy, dividend will never pay, you'll never pay another dime of tax on dividend. And since the benefit is also death benefit in the policy, when you graduate, and then again, we just don't use the word die, we prefer the word graduate, or as my colleague Vern would say, when you become an angel, the death benefit is paid tax-free to your named beneficiary. It provides a growing death benefit, which is paid to your named beneficiary tax-free. Two individuals, the debtor and the saver. Debtor and saver are no different. They're still able to accomplish the objective of buying things, but they don't have zero money to show for when they've used the money to buy the things that they need to acquire. So the solution is to be a wealth creator, and you can be a wealth creator by, again, changing how you're going to flow money. It's not about changing your cash flow. It's not about changing your goals. Your goals are great. They're important. It's about redirecting your cash flow, changing one thing in what you're already doing, and just add this process to what you're already doing, and then you become a wealth creator. So this dark green line, so it starts with 0. So when we start a policy, it just gets started. But as time progresses, this dark green line just keeps increasing. So that dark green line represents your cash value. That cash value is growing every single day to match the death benefit by age 100. And it doesn't matter what happens outside of the policy, your cash value can only go one way, which is up. And as this cash values keep going up and you have an opportunity to access capital, to capitalize on an opportunity, what you get to do is you actually get to borrow against it. So the red bar represents the loan against the policy. So the red bar doesn't indicate that your cash value actually come down. Your cash value is just used as collateral. Your total cash value keeps growing no matter what. You're actually able to borrow against your growing pool of capital. And then once you borrow, you are the banker. So you decide how to pay back the loans back to your system, your own banking system, which is you're borrowing money from the insurance company as a loan. You decide how to pay back the insurance company. You set your amortization. Your amortization could be 1 day. Your amortization could be 1 week. Your amortization could be a month, a quarter, a year, a decade. It's you decide how to pay back the loans to your own company that you co-own, the insurance company. So as you pay back, the money goes back to the insurance company. And then once the loan is repaid, now you're able to reaccess more than what you were able to access the first time, because your cash in the policy just kept increasing all the time. And when you pay back with interest. Remember the grocery store example. You're not going to steal the piece. You're going to pump the money back to the insurance company, principal and interest. The interest becomes profit for the insurance company that you co-own. And once you have more stronger profits, guess what? We have more stronger dividends. We're in this together. There's nobody else to share the profit with. When I pay back policy loans, you'll benefit. Jinjin benefits, Henry benefits, Warren benefits. Everybody who has a participating dividend paying whole life policy benefits because we're pumping the money back into our own system. It makes our business much more stronger, which means stronger dividends for us. And if you're able to reaccess everything that you paid back to the insurance company, principal and interest, the interest doesn't even matter. You pay back $1, you'll be able to borrow more than the dollar back. Because all the time as you were making a loan repayment, your cash in the policy kept growing no matter what. So you become a wealth creator, but just changing how you're going to finance things going forward. It doesn't matter what you need the money for, whether the money is for the car, whether the money is for real estate investment, whether the money is for stock investments, whether the money is for sending kids to college and university, whether the money is for vacation. The whole process of becoming a banker is limited to your imagination. That is why Nelson Nash, the founder of this process, called it the infinite banking concept, because you cannot put boundaries around infinite. It's just limited to your imagination.